On Business Incorporated today. West Africa securities regulators to meet and discuss deepening and strengthening the capital markets in the region. Egypt budgets $20 billion for infrastructural development. And Uganda owes 9.7 trillion shillings and set to borrow more to fund the budget. Welcome to today's episode of Business Incorporated live on Channels Television. I'm Ini John McCall. Let's begin as usual with market numbers. We'll start from major equities in Africa. Sentiments were mostly positive as intraday. Nigeria's main index made a huge rebound, from that negative close of yesterday and the day before. It rose by almost 1% at intraday, while South Africa's JSE was strongly in the bear territory. Its index was down more than 2%. Egypt's EJX 30 rose by 0.17% at intraday, and Kenya closed in the red yesterday on Wednesday. To the Middle East now, where it was mostly negative. Trailed activities in the United Arab Emirates and Abu Dhabi index, they posted 0.95% gain, while Dubai's main index traded lower by 1.36%. Elsewhere in the region, the Qatari index was down almost 2%, and Saudi Arabia's market dropped by more than 2%. Let's go to Europe now. The EU has released a roadmap for ending its dependence on Russian fossil fuels by 2027. The plan packages older proposals with new funding. It also seeks to tempt holdout countries such as Hungary to embrace an embargo on Russian oil. Well, we have Stephen Bursley now joining us from Berlin to give us what the perspectives are to this. Hello, Stephen, good to have you. So what sticks out in this plan?
This is really a repackaging of EU energy policy that incorporates a lot of the decisions that have been made in recent months after Russia began that war in Ukraine. And there we're thinking specifically of the proposed and already decided upon energy bans from Russia, we should say Russian energy. And that includes the ban on coal, which will go into effect in August. That's been decided. The ban on Russian oil is currently under debate. They would like to see that go in place by the end of the year, but there are some holdout countries. And then a ban on gas will take much longer. So there are some incentives here that are meant to make these discussions a little bit easier. The one that sticks out is 2 billion euros in funding for landlocked countries in the EU that really are going to have to make some shifts in infrastructure if there is a Russian oil ban put in place. And of course, we're thinking here of Hungary and Slovakia. Those are the countries that have been holdouts thus far on that issue. This is meant to get a little bit closer to them and attract them to agreeing to this policy. And this is touted as 300 billion euros in spending and new spending. We should point out that the lion's share of this 225 billion euros is actually in loans and loan guarantees. But then there is some grant money as well. And a lot of this comes from funding that's already been decided, for example, for pandemic recovery. So 300 billion sounds like a big number, but again, this is mostly a repackaging that does take some money that's out there as well, but does try and make some headway on these tricky conversations about banning Russian energy.
Yeah, very tricky conversation there. But as you noted, this is like a repackage of an old proposal. So how realistic is it really?
Yeah, that is the question. The realism here would depend on how energy prices react, first of all. That's something that individuals and populations, I should say governments, are going to be watching closely. It's going to be harder as this oil ban discussion goes on and prices continue to climb. For example, if the Chinese economy improves and demand suddenly there picks up, then you're going to see the price of oil rise. And that's even before you start saying no to oil coming out of Russia. That will, of course, shoot it even higher. So that might make some governments rethink. That might make some people rethink. And that might add some fuel to opposition leaders who are against putting these bans in place. So that will make it much more difficult.
All right. And how are the markets at this time, Stephen?
Well, European markets, like their counterparts in Asia, are definitely feeling the after effects of what happened in the U.S. yesterday. All major indexes there falling between 3.5% to roughly 4.5%, and that's because of poor retail numbers from some of the world's biggest retailers like Walmart and Target. That's having a huge ripple effect, and we're seeing similar sell-offs, perhaps not to the same scale, but you're seeing the after effects in Asia, and you've already seen it today so far in Europe. The DAX falling 1.5%, and there were also losses so far in Paris and London.
All right, Stephen, thank you so much for that update. We'll do it again tomorrow. Let's move to the UK now. Prices just keeps going up, not just in the UK, in Nigeria, everywhere, in the United States, inflation everywhere. Well, now we have the prices of parcels and stamps likely to rise again. Royal Mail is saying this, and they're saying it's to cover higher costs, including wages, energy, and fuel expenses. So we have Juliana joining us now from our London studios. Hello, Juliana. Good afternoon. Well, it seems there's no end in sight to this squeeze from all corners.
There isn't any. The cost of living blows just keep on coming and coming. But this Royal Mail story is part of a wider story about Royal Mail, who have had over the past couple of years a pretty tumultuous time. Before the pandemic, they were in a lot of trouble because people stopped sending letters. People were really sending emails, and they didn't really know where they fit into the delivery market. But then, of course, everybody was at home, and Amazon didn't take all of people's money in the online basket. Royal Mail was also able to step in and start pushing up its package delivery service, particularly because it had a very lucrative contract where it was able to post COVID-19 testing kits, and last year that amounted to about 7% of their overall packages volumes. Unfortunately, they gave an update to investors this morning, and investors weren't happy because their outlook suggests that things aren't as rosy as they had appeared, and how they are going to try to mitigate against any further drops in their operating profit is by trying to cut costs by £350 million. By doing this, they are going to erase a wave of middle management staff. So job losses, unfortunately, are to come. But also, as we're seeing, as we've been discussing every single day for what feels like forever, cost of living, and they are going to be putting up prices. Earlier this year, the price of a first-class stamp, which I believe is about 90p, although I must admit I haven't sent a letter for quite a long time, it was increased by 10 pence, and the cost of a second-class stamp was increased by 2 pence. We can expect more of this to come, but despite the fact that they said they are going to try and put together these cost-cutting initiatives, investors weren't happy, which is why Royal Mail is one of the biggest fallers on the FTSE All-Share today. Shares down 11%.
Wow, that's a lot, 11%. Well, just before we get deeper into that market, is this a bit of good news? We hear Rishi Sunak saying that there may be tax cuts for big businesses?
Well, not really, but of course, if you are the Chancellor of the Exchequer and you're giving a speech in front of the CBI, the Confederation of British Industry, which represents, they say, up to 180,000 businesses in the UK, then of course you must go prepared and give them something. And that's what the Chancellor tried to do yesterday. He was speaking at an evening dinner event, which was put together by the CBI. And really the headline, which is what economists in the UK are running with, is the fact that the Chancellor is asking businesses in Britain to do more. He's asking them to invest more. He's asking them to employ more people and to scale up. And he said, if you do this, my government will support you by cutting a tax in the autumn budget. So he got his headline there, but it's just not good enough. If you're talking about the autumn budget, we're talking about a couple of months away when people are facing significant crises now. We talk a lot about low-income families because, of course, we know that they are facing the brunt of this cost of living squeeze at the moment. But, of course, businesses are also facing a huge issue as well. They know that lots of their staff members are overworked. overworked. They are feeling the cost, that they want an increase in their wages. It's really difficult to do that at the moment. They're struggling to get people into the workplace that are skilled enough. We're lacking a significant amount of high skills here in the UK, which is why we've got 1.29 million vacancies at the moment, because it doesn't appear as if there are enough people who are skilled enough to be able to work within those jobs. So that's a huge issue for them. I do have a very small part of the statement that the Chancellor gave yesterday, if you would allow me to quickly read it. He did say our role in the government is to cut costs for families. I cannot pretend that this will be easy. The next few months will be tough, but where we can act, we will act. And this goes into what the Daily Telegraph was saying this morning, that perhaps there are some things that the Chancellor may be able to do. One of them is to reduce VAT, currently at 20% to 17.5%. That universal credit uplift of £20, which was scrapped a couple of months ago. A lot of Tory backbenchers are asking the Chancellor to reinstate that. So potentially there are a few things. However, the big things that the Labour Party and opposition benches were calling for earlier this week, such as the windfall tax, such as an emergency budget before the autumn budget, were voted down by Tory MPs this week in the Palace of Westminster, because, of course, they have got this thumping majority, and Boris Johnson is using that majority to try and stop some of these cash incentives, which would help people that need it the most.
Yeah, well, a whole lot on the plate of the government there, on the economist side especially. Well, let's drill down on those markets and find out how is the market?
Pretty bad, actually. Red is the colour, as it was yesterday. Again, lots of the sentiment is taken from Wall Street in that huge rout, a rout that we haven't seen since before the pandemic. That seemed to have slipped into Asia and definitely has slipped into Europe. Though, of course, in London, we are facing our own domestic issues which are affecting the markets. A positive story for Airtel, though. Airtel has dominated some British headlines this morning. Of course, that's listed on the FTSE 100. Their stock price rose by over 1%. After their new initiative to try and help those who were unbanked in Nigeria get access to the digital banking services, has actually gone down well with investors. Royal Mail, as we just discussed, was one of the biggest fallers. But at intraday, the all-share, the 100 and the 250 all appear to be down by triple digits, by about 2.5%. In the currencies market, the British pound is currently trading up on the US dollar by 0.68%, up 2 on the euro by 0.02%, and up on the Japanese yen at intraday by 0.25% in A.
All right, Juliana, thank you so much for the updates. We'll do it again tomorrow.
Yes, thank you.
Let's go to Asia now. Everybody seems to be pointing their fingers there. Now, the market fell sharply on Thursday trade after heavy losses on Wall Street overnight. Hong Kong's Hang Seng Index was among the biggest losers regionally, falling 2.54% to close at over 20,000 points. Other Chinese tech stocks in Hong Kong also saw heavy losses, with Alibaba falling 7.39%, Meituan shared 3.78%, Hang Seng Tech Index slipped 3.98% to over 4,000. The Nikkei 225 in Japan fell also almost 2% to close at 26,402.84, while the Topix Index shared 1.31% to 1,860.08. South Korea's Kospi dropped 1.28% on the day, while the S&P AX 200 in Australia slipped 1.65%. Mainland Chinese stocks bucked the overall trend regionally as they closed higher, with the Shanghai Composite climbing 0.36% to 3,096.96. While the Shenzhen components gained less than 1%, actually, 0.37% to 11,250.06. MSCI's Broadex Index of Asia Pacific shares outside Japan declined more than 2%. In the United States, futures were under pressure a day after Dow Jones Industrial Average experienced its biggest one-day drop since 2020. Futures on the Dow fell 430 points. S&P 500 futures dropped 1.5%. NASDAQ 100 futures slipped 1.7%. And Wednesday, that was yesterday, the Dow fell more than 1,100 points, marking its worst sell-off in nearly 2 years. The S&P 500 also suffered its worst one-day decline since June 2020. It lost about 4%, while the Nasdaq Composite fell 4.7%. Let's take a break now. When we come back, we'll head to the commodity space and other stories coming to you from the African continent. This is Business Incorporated on Channels Television. You're welcome back to Business Incorporated on Channels Television. Let's talk mangoes in our commodities segment. Its season is almost over. It runs from February, at least here in Nigeria. It runs from February to June. I hope you've had a lot of it before it goes out of season. Because mangoes production is estimated at about 894,000 tons, and that's sufficient to meet local demand. Most likely, this is why we have that stabilizing price or stabilized price when it comes to mangoes. Unfortunately, it's only when it's in season, which is why we're having this conversation with Lawrence Messi, an analyst with Financial Derivatives Company. Hello, Lawrence. Good afternoon.
Good afternoon. Thank you for having me.
Good to have you, Lawrence. So it seems at least we have one commodity that has escaped inflation in Nigeria.
Yes, it seems as though we do.
So because of the sufficient supply, at least for the local demand, we don't see a lot of fluctuation in the price of mangoes.
Well, yes, that's quite accurate. This is largely because, as you rightly said, the production of mangoes in Nigeria is about 894,000 tons. Other sources say 800,000, but it's still within the same range. This amount of production is actually in excess of the available demand because mangoes are actually demanded more for domestic consumption in Nigeria. There's no industrial consumption, so the supply quite significantly exceeds the demand. And a lot of these mangoes actually even go to waste due to post-harvest losses and lack of storage facilities. So it's because of this excess supply as against demand that just causes farmers to actually sell them at giveaway prices. And that's why the price of mangoes are more or less stabilized in Nigeria.
Yeah, and so that brings the conversation to the issue of storage, facility preservation, the supply or production chain. Is there anything or any conversation going on around something like that so that there's a way to preserve it and then we have supply afterwards, after the season, I mean?
Well, supply is a tale as old as time when it comes to Nigerian agricultural commodities. There is a viable investment opportunity in storage facilities. I mean, the market is actually there because these goods need to be preserved. And then there's the post-harvest demand, which is also available, which is why these crops are actually skyrocketing in prices when they are not in season. However, regardless of this viable investment opportunity, you need to look at things like the cost of electricity, you need to look at safety, transportation, and logistics. You need to factor all these costs because there are things that are going to affect any potential investor's business model if they were to venture into storage facilities. But in summary, to answer your question, there is an opportunity and a reason to invest in storage facilities. Whether current measures are being taken to advanced storage capabilities is yet to be known, but it will be interesting to see going forward.
Yeah, and Nigeria is the 10th largest producer of mangoes globally. So clearly, Nigeria does have a competitive advantage in mango production. But I guess the thing is, how do we turn that competitive advantage to economic advantage?
Well, that's a very interesting question. Nigeria does have a competitive advantage because the significant players in the mango space, as it were, in Africa are more or less polarized. We've got Malawi and Egypt as the largest producers in Africa, but just slightly above Nigeria. And then we've got Kenya in the east, and then Nigeria in the west. So there is actually an opportunity for Nigeria to export these excess mangoes, seeing as though the local demand is actually inadequate to meet supply. So there is a business case for Nigeria to diversify its income streams by exporting mangoes. But aside that, we can also look forward to value addition, right? These mangoes the industrial demand is quite low. There needs to be value added. That's processing these mangoes into chips and maybe turning them into drinks and whatnot, or jam as well, or spreads. I mean, all of these processing activities would provide value and would attract a higher price rather for these mangoes, and also provide a business case for exportation, considering that there's excess supply and we can actually gain a market advantage in Africa.
Yeah, Lawrence, just before we let you go now, you talked about, the value chain adding value. A lot of us actually like the mango juice. What stops, we should see a lot more of things like that. What, from your findings is the hindrance, that we should see a lot of mango juice in Nigerian market, but it doesn't seem like.
Well, it's largely due to the processing capabilities, right? Because in order to create, well, mango juice, you've got to have massive investment in processing plants, which incurs a lot of capital, whether debt or equity, and you also need letters of credit and importation of these equipment that you're going to need for processing. That's also now linked again to the volatile exchange rate and the inaccessibility to forex. So all of these factors are quite damning to any potential investor that's looking to set up a mango plant, a mango processing plant that would now make mango juice. So the problem is not necessarily from the availability of the fruit itself, but it's from the accessibility to capital and foreign exchange and the highly knowledge-intensive nature of processing of fruits into juices. I think these are the factors that are causing limited availability of mango juices currently in Nigeria.
All right, Lawrence, we do hope that we can overcome those challenges, and certainly to be nice to have those mango juice very available all round, not just during the supply season or the season for mangoes. Thank you so much, Lawrence. Enjoy the rest of your day.
Thank you.
So moving on now, the West Africa Securities Regulators Association will hold its biennial West Africa Capital Market Conference in Accra, Ghana from the 23rd to the 25th of May. That's a second meeting because the AFDB is also holding in Accra, Ghana from the 23rd. The conference has a theme, deepening and strengthening the capital markets across West Africa through effective regulation. The conference is set to bring together experts, top government officials, captains of industry, international organizations, and other key stakeholders, and provide a veritable platform for networking, as over 300 participants would gather to reflect on issues which affect regional integration and prefer practical solutions to address such issues, while also solutions around where strategic efforts should be focused in the coming year. And Egypt's pipeline for green hydrogen project stands at 11.62 gigawatts. That's equivalent to over 1.57 million tons of green hydrogen, ranking the country in the top 3 green hydrogen pipelines globally. And that's after Australia and Mauritania. Well, the estimated costs for these hydrogen projects without additional infrastructures will be around $20 billion. The projects are expected to come online before 2035. The series of projects announced in Egypt over the past 3 months has captivated foreign developers and highlighted the country's potential. The interest shown by international developers in Egypt is because of some favorable factors, which include the country's location, natural gas, infrastructure, liquefaction facilities, bunkering market, and marine ports. And then we move to Rwanda, where under the theme, full monetization of the economy through commercial agriculture industrialization, market access, and digital transformation, the budget framework paper shows that total resources available for government expenditure will be obtained from both domestic and external sources. Domestic resources comprise tax and non-tax revenue, as well as a borrowing market. The external resources would include budget and project support grants and loans. The government expenditure